We're excited to talk about the world of housing finance, something that I'm very passionate about personally, and we've got a real expert panel of mortgage policy experts that have been around this for a long time. Obviously, you've got a whole bunch of impressive examples of what's possible in housing construction out there on the mall. Someone's got to finance those, and as I know you know, there's all kinds of debates and battles behind the scenes on how we can make that financing possible and how we can do more of it. So without further ado, I'm excited to introduce our expert panel today, starting with Dennis Shea. Dennis Shea, who many of you know, is a former HUD Assistant Secretary, as well as a former Deputy Trade Representative in the first Trump administration. Currently, Dennis is the Executive Vice President of the Bipartisan Policy Center and a chair of the Terwilliger Center for Housing Policy, as well as Jeb Mason. Jeb Mason is a former White House and Treasury official and currently partner at Mindset, a bipartisan consultancy and policy advocacy firm. Thank you, gentlemen, for joining us, and excited to get started.
Thank you. Glad to be here.
So, as I mentioned at the top, there's so much out there that's exciting about what's possible in housing. The financing component is, of course, an issue that we have the ability to work on at FHA as well as a bunch of other federal agencies. And, I think a lot of people don't realize today the world of mortgage lending, particularly true in the single-family side. These firms have become compliance shops that happen to do mortgages, and the collective impact of that regulatory corpus over everything we do, we're talking about $2,000, $3,000, $4,000, $5,000 of additional cost that gets layered on and passed through to that first-time home buyer, the communities we're trying to serve. So I guess to get us started, as we're looking at opportunities to cut that red tape so we can hopefully push through and improve housing affordability across this country, what are some of those opportunities that we can look at HUD and hopefully tackle during this administration?
Yeah, I think you framed it well. Compliance shops that masquerading as mortgage companies, I think, is maybe one way to put it, and I like that. Look, there is an inherent, I think, challenge when it comes to FHA in that it is inherently, by its design, a subsidized lending program. And it's worth sort of acknowledging that and recognizing that means that we've made a public policy choice to encourage home ownership, and you're going to have some homeowners that have a higher incidence of default and higher severity of default. And we want lenders to be making loans to these people that are at the margin that can be successful in sustaining home ownership over time to boost home ownership in the country and all the, I think, attendant benefits that comes with that. And so when it comes to FHA's business partners, I think it's important that they be treated with, a certain amount of respect, recognizing that they are helping fulfill the public policy mission in making loans to these folks. And we shouldn't be shocked then that you have some of the attendant challenges of higher incidences of default. And so I think, FHA and other regulatory agencies being really effective partners with the industry for how we both originate and service these loans and deal with the occasional default is really important. And so I think policy certainty and stability is really important. Another big challenge, I think, for any administration is you can't bind the hands of a future administration very easily. And so I think this administration, the Trump administration in its first term, for instance, executed the MOU with DOJ on False Claims Act liability, which was, I think, a really meaningful step towards trying to encourage more participation in the program. There was progress made on lender level certifications, loan level certifications. Progress has continued to be made in defect taxonomy since then. And so I think you want to pick up where we left off. Now, I think because of this dynamic that it is difficult for any administration to bind the hands of a future administration, and there is a continued fear, the global financial crisis casts a long shadow, I think, in the minds of a lot of lender servicers, and there is concern that there will be gotcha played by a future administration who might see it in their political interest should there be a housing downturn or rising defaults, and for going after the institutions, because in today's populist age that can be a populist thing to do. And I think it's useful if policymakers really on both sides of the aisle recognize that, and then also Congress could take a look at this, for instance, on False Claims Act, and try to give more policy certainty and stability for lenders going forward, assuming, of course, that we want to continue to encourage a high level of participation in the program, a lot of liquidity for servicing rights, and continuing lending to people that are on the margin of being able to qualify on their own, but do have a higher level and incidence of default.
And Dennis, we know a lot of these regulatory burdens are not just FHA requirements, right? There's a whole bunch of other agencies, and also not just the federal government. At the state and local level, there's a lot of red tape that's often layered on as well. And what are some of those other challenges?
Well, thank you, Matt. Let me first of all thank HUD for the invitation and Secretary Turner for being here. You may not know, but today, September 9th, is the 60th anniversary of HUD. So today is HUD's 60th birthday. And I also want to give a shout out to my old office, the Office of Policy Development and Research, for playing an instrumental role in putting this event together. Just to pivot off Jeb's point, at a 30,000-foot level, I mean, FHA, through the insurance it provides for approved lenders, encourages them to make mortgages to promote home ownership, particularly for first-time buyers, and maybe with smaller down payments, and maybe credit scores are not as good as they could be. But this is a bargain. They seem to, the HUD, FHA, and the private lending industry are, as I see it, in partnership. So that should be the mindset. To utilize Jeb's company's name, but that should be the mindset. They're partners, and so in a good partnership, you have clear, consistent communication that's sustained over time. You set rules, clear rules. There needs to be regulation, but you shouldn't do regulation by enforcement. But more generally, the cost of regulatory compliance really adds to the cost of owning a home, adds to the cost of renting an apartment. The National Association of Home Builders has put out widely cited statistics that says regulatory compliance adds 25% to the cost of a single-family home and 40% to the cost of a multifamily property. So that's just too much, particularly when we have a housing shortage. Home sale prices have gone up significantly. Rental costs have gone up significantly. So I commend the Trump administration, which has been through executive orders, has decided that it wants to put a focus on deregulation, kind of removing some of these unnecessary regulatory costs, streamlining regulation. I know in the affordable housing space, compliance with Davis-Bacon prevailing wage requirements adds about 10 to 20% to the cost of a property, so to building that property. So I think suspending Davis-Bacon for affordable housing projects should be something that should be examined. Environmental regulations add to the cost of building a home. I know there's legislation in Congress, the Road to Housing Act, which would exempt automatically infill housing from National Environmental Policy Act compliance regulations. So there's a lot to do in this regulatory area to reduce costs and make housing more affordable.
Sure. Yeah, Matt, if I could jump in, just a couple other things come to mind. I mean, I add to Dennis, in applauding the administration for, I think, focusing on this, making FHA a better business partner. I know, too, your office has, advanced several policy rescissions on the origination side, which I think are in that spirit, including ones on FHA appraisal requirements, on supplemental consumer information, on language preference, pre-endorsement inspection of homes in disaster areas. So I think these are all in that spirit. I know, too, you recently made some policy clarifications regarding claims without conveyance of title. You're getting feedback from industry on that. Obviously, some people in the industry are concerned that's going the wrong way. I know you're bound by statute and requirements of the agency there, but there's maybe a good opportunity for Congress to also look at what they can do to try to help FHA be a better business partner, because some of these are probably not actually serving, I think, their intended purpose of protecting taxpayers, which is probably what's really behind it.
Well, I think, Jeb, that raises a good point that I think on the servicing side, what's maybe not always fully appreciated is the cost assumptions around what it means to be an FHA servicer, particularly since COVID, have really changed as the assumptions around what the policies are for foreclosures, for forbearance, really fundamentally changed post-COVID. And so absolutely, something we're looking at is how can we streamline on the servicing policy side, clear rules of the road, predictability. Obviously, we want partners in the program, and having those clear rules of the road is fundamental to being able to do that program.
Yeah, and maybe one final point here is that, one of the challenges of housing policy generally is that it's diffuse across a number of agencies, and so HUD and FHA alone can only do so much. So I think, CFPB is obviously looking at their rules related to servicing and Reg X, and I think a lot of the industry would like to see that, some clarifications made to how their servicing rules work. A lot of that was crafted, I think, in response to COVID. Some of that ought to be retained. Some of that probably could go by the wayside and brought, could bring new efficiencies to it. So I think we're encouraged that, CFPB, I think, intends to take that issue up. And there are probably others, that we could go into at CFPB and other agencies as well.
So shifting gears a little bit, as this is the Innovative Housing Showcase, I want to talk a little bit about technological innovation in the mortgage space. It's no secret that so many industries are being really transformed by technology, and the mortgage space is no different. In the last few years, for example, we've seen a real embrace of AVMs, alternative valuation models. A lot of consumers are identifying homes online and based on valuation methods, thinking about alternative credit as well. How are individuals that maybe don't have a traditional W-2 income, maybe gig economy workers, part-time workers, how can they and their particular financial habits be captured? Things like mortgage fraud technology, things like customer acquisition. These are all opportunities to innovate. I'm curious if these can drive cost savings that ultimately benefit the first-time home buyers that are ultimately trying to use these programs.
Well, I think home building particularly is a perfect place to bring more innovation into the sector. Productivity in home building has really lagged productivity in other sectors. So as you mentioned, Matt, alternative valuation methods are using large data sets to assess the value of homes and sort of bringing AI into the home appraisal space. We at BPC think a human should be involved in that to verify that the AI-generated appraisal is correct. As you mentioned, AI is being leveraged to incorporate non-traditional components of credit scoring like rent, on-time rent, and utility payments to assess credit worthiness. And I think that's important and can improve effectiveness. But of course, a lender needs to be able to explain why a decision to deny someone access to credit. We see now even AI being used by some local communities to help them with their property tax assessments. We see AI outside the financial space being used in pre-development. AI is being used to help with developing alternative designs for home building and for siting homes, being used to assess compliance with land use and zoning regulations as well as building codes. I had the good fortune of recently talking to the president of a company called Reframe Systems based in Massachusetts, which is using AI robotics in microfactories to build modular housing. It's really, really fascinating. And I think his company just won the Ivory Innovation Award out in Utah. So AI is also being used in conjunction with mobile robots, drones, to look at on-site building to make sure that the building is going according to the timeline that's been agreed to and according to design specifications. So We're in the AI world, and I have a feeling it's just not going to impact the mortgage market or the home building market. It's going to impact all aspects of our life going forward.
Jeb, what are your thoughts?
Yeah, look, I think a theme here, I think, is really that kind of ties together the tech and the regulatory conversation is, if you want to bring more capital into housing, enhancing confidence is important, right? And so Dennis already touched on it, but like in underwriting, I think there's tremendous opportunity related to alternative data. I think there's a lot of confusion about alternative data too. Like the current FICO score, I think, does incorporate utility data, for instance. It doesn't incorporate rental yet. So you have two new scores from both VantageScore and from FICO that would incorporate rental data, but only to the extent that data is existent in the credit file. So, a good place, I think, for policy focus upcoming is how do we get more of that data reported into the credit file. Companies like Built Rewards and Isuzu, for instance, are working on things like that. So I think those are really positive potential, but I think it's only by having the best, most accurate, most predictable data that you maximize credit availability to worthy homeowners without increasing risk, right? And so it's like know your risk is a key theme here. I think trended data has real promise too. I mean, there's a difference between someone that, for instance, has their utilization spike periodically, but then pays down their credit card as an example, but and someone else that is using it to roll over and over again. And so by looking at rather than just a snapshot in time, but a broader set of data, we can actually I think we can either continue to lend to the same universe of people with a much lower default rate. I think estimated trended data could lower defaults at FHA by 25% or more. Or you could expand credit availability to that many more homeowners without increasing the risk to taxpayers and incidence of default. So a lot of potential promise there. I think, specifically like what would be needed, like in that case is, Ginnie Mae, I think adopting additional data fields into their system so you could actually include additional scores. You already hit on AVMs. So I think, there's a great deal of promise I think that technology can bring and larger data sets to making sure you understand the collateral value and making sure that's as accurate as possible. And so in some ways, I think the mortgage industry was set back a decade in terms of its technology development because of the global financial crisis and the response related there too. And so, there's a time now, I think, where we can take advantage of a lot of technology. Lastly, just, going back to something I mentioned before is we have rules in place, I think, that actually tend to slow the pace of technology and its ability to, qualify borrowers and get them clarity on what they can afford quicker. And so there's room for improvement at CFPB and elsewhere, I think, to help look at RESPA and some of the other rules that have historically, deliberately drawn out that process so that you can get closer to, the vision I think that a lot of people have of much more tech-forward mortgage where, a homeowner can be driving a neighborhood, see a house they like, and they can know immediately, with their phone, what that home costs, whether they can qualify for a mortgage. I think that's the vision that a lot of people are working at. And to a theme you mentioned at the outset, Matt, I think it is often regulation that's the primary impediment to doing something faster, quicker, more accurate. So it's a good area that's ripe for examination by policymakers.
And the models are only as good as the data that's available, right?
That's right.
So I'd be remiss in this conversation not to talk about the big beautiful bill, which we're super excited about its potential to supercharge the financing on single family and multifamily. I think one element of the law that maybe hasn't gotten enough coverage is the renewing of the deductibility of mortgage insurance, which in the FHA book not only provides an affordability benefit for FHA buyers, but also a cost savings from a tax standpoint for current FHA borrowers who have been in the program perhaps for years. So I know we're really excited about that provision, making it permanent. What are some other items, either single family or multifamily, in that law that are going to supercharge the ability to finance the construction of all this housing?
Well, at BPC where I work, we don't like reconciliation as a process because it's inherently not part of it's partisan. So, but the One Big Beautiful Bill Act is fantastic for housing, in my judgment. First of all, it permanently updates, and permanently expands the Opportunity Zone incentive, which has been shown to have raised tens of billions of dollars of private capital in these opportunity funds that have in turn been deployed for housing. I've seen estimates ranging from 200,000 to 300,000 homes have been built as a result of the incentive since 2018. So it's been the Opportunity Zone concept. It's been updated to sort of target more lower income communities and rural communities. So that's a big plus. The One Big Beautiful Bill Act also permanently strengthens the low-income housing tax credit, which is our most important affordable rental production program. It incentivizes private capital to come in and build affordable rental homes. So it does that by making these 9% credits. It increases them by 12% permanently. Makes it easier to use the 4% housing credits by reducing the private activity bond test. These are housing nerds in here, so this is not too complicated.
That's the point of this panel.
From 50 to 25%. So estimates suggest that that those two provisions will create 1.2 million affordable rental homes over the next 10 years. The bill also permanently authorizes the New Markets tax credit, which is used for economic development in low-income communities. It can be used for a variety of purposes, including housing, mixed-use housing, and affordable single-family for-sale housing. So that's a win. So at BPC, we're very, very positive about the One Big Beautiful Bill Act. We hope Congress takes up at some later date something called the Neighborhood Homes Investment Act, which is a tax incentive to encourage private investment in for-sale homes, to rehab and build homes that would be owner-occupied in distressed communities. And the whole point of this is that we're leveraging the tax code to encourage more private investment in affordable housing. We're not going to solve our supply shortage with government action alone. We need to get the private sector more involved. So opportunity zones, LIHTC, New Markets tax credit, Neighborhood Homes Investment Act, not in the bill, but maybe in the on-deck circle. All those things would do that.
Jeff?
Yeah, just back to lens out. I think President Trump came to office last year. We were telling clients that, look, really housing policy and housing affordability, we think, is registering as a political issue like no time I've seen since at least the global financial crisis. And so I think there's a lot of opportunity in that. And while Dennis is right, like the way the chips fell in the election, you've got unified Republican government in the White House and both chambers of Congress. Inevitably, you're going to use reconciliation procedures for some of this. And so that's an inherently partisan process by its nature. But it's important to point out, I think, that these provisions, to Dennis's point, aren't partisan. They're bipartisan. In addition to the ones he mentioned, which was a good list, bonus depreciation, the bill, I think, permanently restores 100% bonus depreciation rate for certain property placed in service after January of 25. That allow multifamily investors to immediately write off various items like appliances, HVAC. So that helps with just the cost of producing new housing, which is really the best way we're going to address affordability is just building more. And qualified business and income deduction also, the QBI for pass-through entities is increased from 20% to 23% and made permanent. So commercial, multifamily, investor-owned, single-family rental operators can benefit from lower effective tax rates on the rental income and development profits. And again, so if you do that, that may sound like just a benefit for the owners, but it actually helps more projects pencil out and encourage people to deploy capital in support of new housing production.
Let me also make a pitch for the Road to Housing Act, or something similar to that, Matt. This is legislation. I view the One Big Beautiful Bill as Act 1, and Road to Housing or comparable bipartisan legislation as Act 2. This is legislation that was marked out of the Senate Banking Committee 24-0. Now you don't see that a lot in Washington, D.C. A bill where members of both parties got together and said, we're going to try to do something to improve housing supply, reduce regulations, and make housing more affordable. I wouldn't say anything in that bill is like a Aaron Judge or Shohei Ohtani provision, like a superstar provision, but there's a lot of stuff in the bill that are like 260 hitters, 270, like 20, 25 provisions that could really make a difference. And one of them is removing the permanent chassis requirement that's in the National Manufactured Housing and Construction Safety Standards Act. Manufactured housing is required to be built on a permanent chassis and then transported to where it is. But in fact, many manufactured homes are laid on a permanent foundation. So this permanent chassis requirement has been used as a kind of a blocking device by local communities. It also has added costs to constructing a manufactured home. So removing those words from the statute would be a significant thing and really improve access to manufactured housing, which is frankly our most affordable, unsubsidized source of housing in the United States.
So one topic I also really want to make sure we get to is the topic of accessory dwelling units. This is something that there's a lot of attention on the Hill the last several months about. I know I personally have a friend that has an in-law that in-law suite that's attached to the house. Sometimes it's like the conversion of a space in the garage or something like that. And one thing that in the FHA program we've really looked at really closely how we can maximize the potential is ADU financing. So we allow, for example, the prospective rental income. So if you're going to buy a house that has an ADU and you're going to rent out the ADU, you can use a portion of that income to qualify to purchase the house. And so it's an opportunity that will make more sense in different types of markets than others. But again, given the affordability challenges, these are the types of things that increasingly are getting a lot of attention. Have you all been tracking this issue, and is there potential there to maybe further expand what's possible within attached ADUs, detached ADUs, or maybe what are some other topics along those lines that are kind of innovative ways around the box to be able to afford a home?
Well, ADUs are a big deal these days, as you point out, Matt. I mean, California has passed like 6 different ADU laws over the past decade. Republican governors like Spencer Cox of Utah and Greg Gianforte of Montana have made ADU, giving property owners the right to build ADUs, a big part of their housing affordability agenda. Now, it's my understanding, and you can correct me wrong, Matt, that in 2023, FHA allowed the prospective rental income from ADUs to be used to determine whether a borrower qualifies for a 203K rehabilitation loan. But it does. What is left off as an eligible improvement are new and detached ADUs. So maybe extending, and maybe that would require legislation to extend the eligible improvements to new detached ADUs.
Mm-hmm. Yeah, I was just gonna tell a story, maybe kind of interesting, but the first home that my wife and I purchased together was in a conservation district built in 1920. All the piers were actual stumps of cypress trees, which was interesting if you went under the basement of the house. But one of the things that I found interesting about that neighborhood, because it was a conservation district, most of the houses in the neighborhood had a bedroom with a separate entrance attached to the house, right? And I think that's because fairly obvious that, like, at the time, it was really important that additional rental income was often a renter, and that was helping people afford the home. And so whether it's attached or detached, I think being able to encourage that additional density and then being able to consider the fact that you will have rental income to help offset the cost of the mortgage can make a difference to affordability, getting more qualified people who can sustain a mortgage into homes. and helping encourage just the addition of supply in a relatively rapid pace.
I mean, that's a really important point. It's not just a rental thing. It's not just a supply thing. It's an access to home ownership
Right.
tool.
Right.
So, Dennis, you mentioned earlier in the manufactured housing space, obviously we've got a lot of manufactured housing and modular displayed here at the showcase. Obviously, within FHA program, we have both the Title II, which finances real property, as well as the Title I, which provides a potential, although fairly untapped historically, recent history at least, source of financing for manufactured homes. What are some of the challenges for either of you in the manufactured housing financing space, and how can we potentially tackle them?
Well, I guess some clarity around financing. My understanding is that most manufactured homes are titled as personal property, about 80%, and 20% are titled as real property. And if you want to get a mortgage, you have to retitle it as personal property, and how to do that varies state by state. So I think overcoming that obstacle is really important. I think local zoning regulations often prohibit manufactured homes in single-family zoned areas. We did a little case study at the BPC on Jackson, Mississippi. They had a local law that prohibited mobile homes from being in the community in single-family zoned areas, when in fact these are mobile homes that are based on 1970s definitions. So they changed that and have allowed manufactured housing, beautiful manufactured housing, in the communities. So I think the biggest stigma from what I've heard, biggest obstacle that I've heard from people in the modular housing, manufactured housing business is stigma associated with the product, consumer lack of education among consumers. So I think a big part of this effort here today is to show these are beautiful homes. They're just like any kind of site-built home, and they should be welcome in any community. And the manufactured homes, as I understand, the price of a manufactured home is about 1/4 the average price of a site-built housing. So this is an incredibly important source of affordable housing, unsubsidized, in the United States, that we need to tap to make sure to help us solve the supply deficit problem that we have.
Yeah, I'd pick up on the theme from earlier too. Like in Title I and Title II, both for personal property and for real property loans, I think servicing conveyance changes could be looked at. I think in Title I, lifting the origination fee cap would help more of those personal property loans be made. I think that aligning FHA inspection requirements with HUD's inspection requirements, similarly their foundation requirements with HUD's, are things worth examination, not to put you on the spot. And, there's some limits on or prohibitions on financing of relocated homes that I think you could look at too. But look, the good news is I think there's a strong bipartisan recognition that we have a housing supply challenge and an affordable housing supply challenge. Manufactured housing probably represents the most affordable housing ownership option out there. It's also true that, like, if you want to make a dent in this problem, not to be political about it, but inside the next 4 years, you're going to have to look at factory built and just taking advantage of the efficiencies that are there. And I think that, we're really, excited, and I think the industry was excited to see that FHA put in its latest OIRA agenda. They came out of the White House and OMB, an intention to look at regs related to chassis, which Dennis talked about. There's legislation moving too in the road on that, but I think strong bipartisan support for removing the chassis requirement, which does seem outdated and antiquated, and to be holding factory built housing back. There's also, a really critical issue, I think, for the industry is making sure there's going back to the theme of policy certainty and stability, making sure there's one single regulator for manufactured housing. Manufactured housing is unique in that it has a federal building code controlled by HUD, shorthanded as the HUD code, the HUD code. And so other federal agencies who are developing building standards for, manufactured housing ultimately should be, HUD should be the final decider and authority for what the manufacturing standards are under the HUD code. And so I think there's bipartisan legislation also moving in that regard. I think a couple lawmakers you've already heard from are intending to introduce or move legislation to that effect this year, so we're really encouraged by the opportunity that exists there.
There's a provision in Road for Housing asking HUD to look at whether to have a single federal standard for modular housing. So I don't know what folks think about that, but that's in the Road for Housing.
Well, it's interesting, Dennis. I think if you remove the chassis requirement, you may actually effectively achieve that. So that's, there's maybe an interrelationship there.
So we've got a few minutes left in closing. Jeb, you mentioned at the top, FHA has historically, through enforcement actions, et cetera, pushed some participants out of the program. And I think we recognize the more competition we have, the more different types of business models, non-bank bank, community bank, credit union participating in the FHA program, the more competition there is that benefits consumers. And so one thing we're focused on is how can we be a better business partner? And we're really focused on that because we want to bring back participants in every community across the country. What are some of the opportunities for FHA to kind of convey to the lending community, we want to partner with you, we want to be a predictable business partner?
Well, I think it's saying things like you said, for one. I think so listening to industry is important. Outreach, having carefully considered, coordinated, and communicated policies is really important. Not just out of FHA, for instance, but across the government. Again, a lot of different agencies touch housing. So I think, there have been people that have recommended, I don't know if you need a housing czar per se, but I think you do need someone at the White House who's looking across all the agencies that touch housing, FHA, VA, RHS, Ginnie Mae, HUD, of course, more broadly, CFPB, FHFA. There's an interrelationship there that's really important. And I know, I don't want to go down the rabbit hole of talking about GSE reform, but there's obviously a lot of interesting discussion around the future of Fannie and Freddie, and some of that has very direct and some of it has very, indirect impacts on these other agencies. So we have to look at it as a comprehensive whole, which I think is important. I think for the administration to signal that it's interested in input is important. Treasury's doing a bunch of roundtables on that question, kind of as we speak. Which I think is really important. But I think in the FHA context, what you're saying, Matt, I think has been, really welcomed by industry. I think continuing to, there's been some hand-wringing, I think, about servicer liquidity, but one of the best ways to address servicer liquidity is have more people interested in servicing FHA mortgages. And so now there's only so much you can do, though, from your seat at FHA, candidly, I think. Not to say you shouldn't do everything you can, but I think banking regulators, for instance, can play a role too. This administration has signaled an intention, I think, to finalize what was once thought of as the Basel III regulations, and I think it ought to do so. But it needs to look very, and it's also signaled that the treatment of mortgage within that complex is an important thing for them to examine. So I think that would be really welcomed. There's the treatment of warehouse lines for banks. There's the treatment of MSRs for banks. There's the just general capital and liquidity rules. There's the treatment of securitizations. And so there's, I think, a lot of opportunity within that rulemaking to make a dent in terms of the attractiveness for banking institutions to be in mortgage. And as you know, a lot of times originators don't necessarily know at the point that they have an initial dialogue with the consumer what their execution channel is going to be. So it could be FHA, it could be conventional, it could be non-conventional. So I think a coordinated housing policy would make a big difference, and transparency, policy certainty, as much as you can muster without Congress is key. And then Congress also ought to play a role in helping creating that additional layer of policy certainty and stability that can transcend any single administration.
Any other thoughts, Dennis?
No, I think, as Jeb said, you said it, being a good partner, being transparent, being a good communicator, setting clear rules going forward, and communicating frequently to your partners, and viewing, the lending industry as your partner in promoting home ownership, and particularly first-time home ownership, is a critical to the way of thinking. And Jeb mentioned GSE reform, where this is not what this topic is about, but there is a contemplating at the exit of the GSEs from their 17-year conservatorship. So part of that is, what is the GSE lane? What is the FHA lane? What is the VA lane? What is the USDA lane? So that, as Jeb mentioned, there's so many different housing programs scattered across the federal government. Getting a little more clarity about what the respective roles and responsibilities are for these programs would be critical.
So I think a common theme the last 45 minutes or so is we've got a lot of opportunities to help improve the way these programs work, which ultimately, of course, we know that passes through in the form of more affordable housing so we can build more, so we can go build the stuff that's out on the mall. So really excited about the potential we have to work on these issues. Please join me in thanking Jeb and Dennis, our panelists. And we hope you all enjoy the rest of the showcase. Thanks.
Thanks.